Okay, I want to welcome everybody for this week's tutorial. Today is May the 5th, 2018. This is a class for credit and credit risk and credit as an asset class for the 5th tutorial. So thank you, everyone. I've got quite a few things I want to show you. All of them will be interesting and useful. And what I was hoping to do, actually, apart from some sort of macro observations, I want to just talk a little bit regarding ISDA and Credit Support Annex. Now, I know that we did touch on this. We did do that when we were dealing with when we were in capital markets, and I took that opportunity to share with all of you what ISDA is all about. But now that you have another practitioner who specializes in one of the derivative markets, which is credit, okay, I hope that when we look at this again, it will make more sense to you and you are able to relate to it easily. Okay? And I also I want to have a look at the quiz that was done, not last night, too easy, but last week when I was away at an appointment. What you find is that for the quizzes every week, when Ryan is asking a kind of descriptive or text-based question, where he's really just testing whether you paid attention in class or not. So those quizzes I probably will not go over, but when there are numbers involved, like last week, I do want to just share with you because the final exam, at least a part of it, may well be in that kind of style. So we're going to do that. All right. Now, before we start, is it hot? Winter is over, right? In case you haven't realized. Oh, it's already on high. Doesn't feel like it. I can't carry the temperature down. Oh my god. You're all gonna die here. Alright. If you I can't do anything else. So let me ask somebody, or someone can put that hand up voluntarily at some point. What happened last night to, let's say, the stock market? What happened to the US market overnight? You guys are not college. That's not a good way to ask. You guys are not investors? Not big investors, but you are market. So do you know what happened last night? The screen, right?
Yeah, I just saw the pop up on my phone that the stock market yeah, but I don't not what happened.
Okay. Thank you for that. Does anyone know what actually happened? Maybe nothing happened. What happened last night? Sorry? Somebody said something. You said something. You don't need to Google it. Okay? You don't need to tell us. I know it. I'm just curious whether you will follow it. So what happened last night?
And actually they face very serious support demands, yeah.
Oh, don't
prohibited China.
What What do you think of that? You freely
I
express
really
it.
don't know how Chinese government is going to deal with that. It seems that we don't have that much of power to
Against the US.
yeah.
Then you have more power.
Okay.
To start with, China is the largest creditor nation to the United States. So that just means it's one of the, it's either the top or second, together with Japan. And that means they are the biggest buyer of US Treasury bonds, amongst other things. That means the United States as a country constantly and continuously needs funding from other countries. It's not a secret, everyone knows. So I really don't know what Trump administration is. Well, I kind of know what they're thinking. I'll share with you my view. Yes. Once you get me going on that topic, I can't stop. More, it's true, they sent Xi to Beijing, and I think they're still there. But what I was thinking of was, okay, last night was the first Friday of the month, correct? Yeah? Now, what happens to markets is that the first Friday of the month in the US, they released what's called the employment situation. They don't call it the unemployment report because it sounds really bad. The employment situation report, which is the first Friday of every month. Unless the first Friday is actually the first day of the month, in which case they delay it to the week after. But anyway, that's unemployment. So last night was that day. So if not if, when you guys, some of you will join, the finance industry, either as traders or sales or as fund managers, investors, hedge funds, the first Friday of the month is when that release is at 8:30 a.m. Washington time, which is 8:30 p.m. in Hong Kong, or 9:30 p.m. during winter. So the first Friday of the month at night, when you go into any bar, first of all, if you have trading friends and you ask them to go to dinner, probably they say no, because they will ask to stay back. Or when you walk into any bar in Hong Kong, people at around 8:30 at night, this time you make an observation. So right at that moment, the people are not really talking to each other. What are they doing? That's what they're doing. Okay? Because that report actually has a lot of impact on markets. And I think last night there was a good report in terms of unemployment. Unemployment dropped below 4%. It hasn't done that since Bill Clinton. You know Bill Clinton? He was president about the time when we were born, before we were born. And it hasn't done that for almost 20 years. Has it really been that long? Now unemployment is less than 4%. I'll say a bit more about that in a moment. Because there's a bit of bullshit in there. I'm going to try and tell you what that is. Or maybe you can tell me. I actually got, okay, so here is the timetable. So now we are becoming quite meet every week in this room, except I think on the 19th of May, where the room is changed. This is not a typing error, right? That's why I underline it. It really is changed. 210 is around the corner. I have been, as you know, making videos of the tutorials, really just for your interest. And I have uploaded some of them, the first 3 at least. And when you click on the links, if you really want to know a particular segment, okay, one good way for you to use these probably is when we are here, and if there's something you don't understand, but you either I'm talking too fast or you don't get to ask the question in time, you just note down the time, and then when I produce the video, you just forward to that point, and then you can listen. Don't listen to the whole thing unless you can if you want to, right? But you don't need to. So today is the 5th. So I have to put the video on for last week and today, and I will. Okay. Now your final project is coming up, as you know, and if you haven't heard, so Ryan was saying last night that on second thoughts, he thought that the requirements that he's the one who actually he came up with all those things. Okay, he thought it was just a bit too much, so he said, all the teams, why don't you just focus on 4 items from this list here, okay? Which 4 is up to you, okay? So I hope you guys are working well on that. The deadline is May 27. Seems like it's a long way away. Actually, it's not. That's a Sunday, and so we like you guys to hand in the deliverables before the class starts. We have a class on Sunday, May 27. Okay. Anyway, just focus on 4 items. All right. Now I got an email from someone, and I thought it was worth sharing. Oh, hold on. Yeah, this was the. I don't know if you saw this, but this was the headline overnight. It might still be the headline in the Financial Times. So yeah, it is. So Argentina has decided to jack up interest rates to 40% per annum in order to try to prop up the currency, which is the Argentinian peso, I think. Anything that has the word peso after it doesn't seem to do very well. It's which country? I don't mean to be discriminating, but there's what? Mexico, Argentina, Philippines. Yeah, I don't know who else. But anyway, so in Argentina, I mean, look, 40% seems like a lot. You put in $100 in a bank, a year later they give you back 140. Sounds fantastic, okay? The problem is, I'd be happy with 4%, never mind 40. Okay? The problem is, look at the inflation. The official inflation rate is somewhere around 25%. Okay? So what cost you $100 now to buy, in 12 months' time, will likely cost you $125. So when you have 25% inflation, 40% interest rate doesn't seem to be a lot. But anyway, I think I wouldn't want to live in Argentina right now. I heard it's a beautiful country. I'd love to visit. I would love to. I've never been. Has anyone been to Argentina? They got beautiful um, uh, Angus beef, beef steaks. And but anyway, what I was going to say, what was I going to say? So Argentina used to have a currency board, pretty much like the Hong Kong one. Okay? But they gave that up many years ago, and now Hong Kong is, as far as I know, the only country or the only significant economy in the world that still runs a currency board. You know what a currency board is? Currency board is different from a currency peg. Currency peg is the central bank or country comes out and say, okay, I peg my currency to the US, but it's a kind of soft commitment. So we target or we try our best to fix the exchange rate by influencing the FX market as best we can. Okay, so lots of countries have tried that. A currency board, which is what we have here, okay, is when the amount of currency that is in circulation, including the cash that is in your pocket, okay, every single dollar that gets printed as legal tender has to be backed by the amount of available reserves that is in the banking system. And in Hong Kong, we have a lot of reserves. Okay, but if the reserve starts shrinking, okay, then the amount of money that will be in circulation also will decrease. Okay? But anyway, I don't know if this is going to work. I don't think it will. Okay? If they are trying to protect the currency, I think even if they succeed, it's just going to end up killing the economy. I've never seen any economy survive 40% interest rate. You got to be crazy. Okay? But there we are now. One of you actually took the trouble to write to me with this question. So dear Sam, sorry for interrupting you. That's okay. I have recently followed news about the Fed rate hikes expectations and 10-year Treasury yield increase. Okay. All this is going to be quite useful for you when you go out there and you have to start looking at markets. I'm quite confused about the relationship between them. I don't know whether the recent Treasury yield burst, I assume that means going up, okay, is due to both the inflation and the Fed rate hike expectation. What are the main driving force for Treasury yield change? I have read articles which says the Treasury yield and Fed funds rate would not necessarily go in the same direction, but this time most of news comments directly link the increase in yields to Fed rate hike expectation. Okay, do you understand this? Do you have the same query in your mind? Do you sometimes wonder what is the relationship between the Fed funds, which we took a lot of time explaining 1 or 2 sessions ago, and the relationship between that and US Treasuries? Probably you do, okay? So also, I remember you mentioned a narrowing gap between yields for 2 years and 10-year Treasury bond could be a could indicate a future recession, and the IPA professor, just call him Professor Fong, okay, Um, he has a name. Also talked about the high CAPE of U.S. market. Yes, I ran into him in the lift today. He looks well. However, from the recent disclosed data, it seems the U.S. economy is in a prosperous track, given the 1.9% core PCE. So inflation is under control. Okay, that's what that means. And then the low unemployment rate. It is true. I wonder if you can help me figure out the real relationship between these two. Please offer your opinion. Okay, now I am just giving you my opinion, so you don't have to agree with it, but I do ask that you try to listen. Okay, just sharing with you from my experience. Now, if you look at the U.S. Treasury curve, so there's a very, very short end, between 0 and 6 months. Those are called T-bills. And then there is a 2-year point. So there's 2-year Treasury. And then there's 10-year. So here they're called bills. They're called T-bills. And here they're called T-notes. Especially the 10-year is called a Treasury note. And beyond 10-year, they are called T-bonds. You know that, right? But so these are all fixed income instruments, and in a normal upward sloping environment, what you tend to see is that the Fed funds has direct and very noticeable influence on the 0 to 2-year part of the curve. So when Fed funds are going up or starting to go up, they don't even have to go up all the way. When Fed funds are starting to, and we are in that part of the cycle now, the 2-year is very, very sensitive to that. And it could even go up before the Fed funds, the rise, the tightening cycle is completed. Now here would be fairly close to the Fed funds. But the 2-year is kind of in anticipation. And when they feel that interest rates are on the rise, then the 2-year is very sensitive to that. Okay, so if you do a regression, or if you want to look at the correlation between the Fed funds and the various points on the yield curve, I'm sure you'd find a very, very strong positive correlation between Fed funds and the 2-year Treasury yield. Okay. Now the thing is, Fed funds is a policy tool where a central bank tries to manage inflation. And inflation actually has substantial impact on the 10-year. So you could say that indirectly, when Fed funds start to go up or down, it directly impacts the 2-year, but it also has impact on the 10-year. But the 10-year, it can be impacted by a lot of other things. It's not just inflation. It's not only that, okay? It is, for example, simple supply and demand, okay? If China starts selling U.S. Treasury and they tell the whole world about it, they haven't been they've been quite controlled, quite restrained recently. So they haven't done that. But if they were to do that, and if the world knows about it, if suddenly they say, all right, we are going to start unloading our U.S. treasuries, okay, so there is no doubt that the price, bond price, or the T-note price will drop and the yields will rise. So there are other factors. Okay, the fiscal outlook is another consideration. All right. So if the government keeps saying that they want to build this, build that, build a new airport, upgrade their motorways and this and that, and then they cut their taxes, okay, where's the money going to come from? It's going to come from somewhere. Okay? So they would have to issue new bonds. When you get out to the 30-year, okay, so this has more to do with, I guess, the medium to long-term sort of credit quality or credit worthiness of the U.S. and also sort of longer-term economic prospects. Okay, so all of those things. So in any case, getting back to the question, and the question was, never lose sight of the question. Okay? The question was, what are the main driving force for Treasury yield change? Well, my first response to that, if I was in an interview and someone asked me that question, my answer would be, well, it depends on which part of the curve you are talking about to start with. Okay, if you are talking like the 0 to 2 year, okay, the main driving force is short-term interest rate outlook. Okay, the outlook for short rates, but beyond that, it is, the 10-year, the 7-year, 10-year, 30-year. It can be a lot of things, like inflation, like supply and demand, like the picture on the fiscal side, or whether there is a war going on, or some kind of, what is the global geopolitical climate, for example. People are nervous. U.S. is going to go to war with Russia or with China. Okay, right now it doesn't seem to be. If anything, peace seems to be the fashionable thing now. Okay, to be peaceful. So all of those things. Okay. Now, I've read articles that the Treasury yield and Fed funds will not necessarily go in the same direction, but this time, news of most comments directly linked the increase. It is true. They don't have to go in the same direction. Well, look, I think the Fed funds and the 2-year, a lot of the time they do go in the same direction. But when you talk about the Fed funds and the 10-year, no, they don't have to go in the same direction. Sometimes they do, sometimes they don't. Okay, okay, and then now this person, and I'm grateful for this email, is asking the narrowing gap between the 2-year Treasury and the 10-year Treasury. When the gap is narrowing, that must mean that the yield curve is what? If the points between the 2-year and 10-year, if the gap between the 2-year and 10-year is narrowing, what does that mean? It means your curve is flattening, right? I've actually, because I got quite interested in this question, and I prepared some notes on that, okay, regarding not all scenarios, but some scenarios where yield curves can move in different directions. Now, first, I'll give you some background. Okay? This is a website where you can look at yield curves of, I think, government yield curves. It's called Bond Supermarket. Government yield curves of different countries, and you can compare the yield curves on different dates. Now, do yield curves move in parallel? I've kind of given you a hint there. Do they? Did you learn about that in fixed income? Yeah? No? Do they move in parallel? No. Never. Well, when I was in grad school, they didn't teach me that either. I learned that on the job. Generally, okay, this is what you are likely to find in most fixed income markets, what I call a 70-20-10. Okay? Now, it may not be 70-20-10, don't worry about that. It could be 65-20-15. Generally, 7 out of 10 times, yield curves do move in parallel, or close to. It may not be exactly parallel, okay, but close to being parallel. The long end and the short end, I'm talking like basis points, okay? So they move by the same amount. So if you take 100 days or 1,000 days, okay, you are likely to find that in 700 days, the yield curve is pretty boring, and it moves up and down by, if not exactly the same number of basis points, at least pretty close. Okay? The other 20%, all right, is when you get yield curve movements, like slope movements. Okay, so this is parallel. This is sometimes called twist. Twist is just a fancy word for steepening or flattening. Okay, actually, let me do it here. So if the curve looked like that before, and then it looked like this after, okay, so that would be a flattening, but it's sometimes called a twist. Okay, the last type, does anyone know what that is? The last 10%? Curvature. Yeah, thank you. Sorry, your name is, I know you. Right, thank you for that. It's sometimes called butterfly, I think. The name is not important. Okay? Now, butterfly means this. So the curve looked like that before, and then the shape changes. So this is not a parallel move, no. This is not flattening or steepening either, okay? It's a bit of both. Where the actual, she said curvature, that's exactly the word. So the curvature has changed, okay? Now, so this is what you find. And so when the 2-year and the 10-year, when the gap is narrowing, so never mind the last type, okay? So that basically means the curve is flattening, okay? Now I want to go one step further, okay? So scenario 1, parallel move, scenario around 70% of the time, plus or minus 5%, okay, doesn't matter. Most of the time, right? And then followed by a curve steepening or flattening. Okay. Sorry, I didn't mean to, this is a typo. Okay. This is a curvature change, my apologies. curvature. I think this is called a butterfly. I want to focus a little bit on the second type, which is steepening and flattening. Have you heard this in fixed income? If you have, I don't want to waste your time. Have you? No? Okay. So parallel move is rather boring, but it happens the most. Okay. Now, when you have flattening, a curve getting flatter, there is actually a distinction between what's called a bull flattening or a bear flattening. Okay. Now, bull flattening is you have a curve and then it gets flatter because the longer dated yields are falling and the short yields are not really moving much. Okay, you can have a bear flattening. You can have that too. Now that is when the long yields are not moving much, or if they are rising less than the short-term yields. Okay, so the short-term yields are rising more. Okay, I mean you can just imagine in your mind you've got a curve, right? So only two things are moving, the long end and the short end. The long end might be rising, but if the short end is rising more, of course you've got a flatter curve, right? Now, I underline that, okay, because that seems to be what we are what's happening right now. It seems to be that's what we're having, okay? I'll show you in a moment, okay? Now then there's steepening. Okay, there's bull steepening, and you guess it, the last one. There's bear steepening. Okay, so bull steepening. First of all, the curve is getting steeper. Okay, that's when long yields are not really changing much. Okay, so the bull and the bear, these are referring to changes in bond prices. Okay? So bull steepening means the steepening comes from a rise in bond price, and because bond prices are rising because short yields are falling. Okay, so short bonds are rising. Okay, short bonds price rise. Okay, now so on your right hand side, I try to give you a bit of commentary. So I mean, it's very well to know what these things are, but when the hell do they happen? Okay, so I try my best to give you some examples, and actually I printed it out. Just for take a copy. So on one side is that question that was asked. On the other side is actually this table. The reason I want to do that is I actually want to go to the US Treasury website. Can I have a copy? So I'm going to show you some examples. Okay, so now let me see if I can call up what I want to do. No, I'm just going to have this page in front of me. And then I'm going to try and go to the U.S. Treasury website. Here you go, U.S. Treasuries, and I'm going to have a look at this is actually comparing the 2-year and the 2-year every single day, and then the 10-year every single day, and then, but this is not. I just want to have a look at the yield curve. Okay, just bear with the one I'm looking for. Okay, so don't worry about the real yields. That's the inflation-linked market. So if you look at scenario number 3, so I'm going to compare May 2008 to May 2018 to May 2017. Okay? So when you are talking about curves flattening or steepening and this and that, you are talking about the curve traveling from A to B. You have to specify some kind of a time frame. Okay, so what did the curve look like 12 months ago? Now, as you can see, so the long rates didn't really move very much. Okay, 12 months ago, but the short rates have shot up from just a little over 0.5% now to close to 1.7%. Okay, so this is a classic case of a bear flattening. Okay, is everyone with me there? Right. So I try to describe to you under what circumstance that is happening. So the market overall, or at least the longer term bond market, is not too worried about inflation, or they think inflation is under control, but the short end, which is very heavily influenced by central bank action, is moving up, point for point. One more thing I can say on this topic, if the yield curve looked like this, and then suddenly the central bank gets together for a meeting and they decided to increase the interest rates. So we know that the short end will increase. Okay, so that we have no doubt. But sometimes the long end might do this, or the long end can even do that. Okay, so the long end rises even more. I have seen both, actually. Okay, sometimes it can fall, sometimes it can rise even more. I think they are telling you different things. Okay, when they increase interest rates and then the long end falls, okay, so then you basically have a flattening. That normally means the market is quite comfortable that the central bank is managing the inflation risk quite well. Okay, so when the short end goes up, but the long end comes down, so the market is not too worried about inflation, and they think that by increasing the short rate, okay, inflation will remain under control. Now, under what situation do you have, when they increase interest rates, and then the long end goes up even more? This is when what we call, the central bank is behind the curve. So that means they are lagging behind. So that means there is a serious inflation problem, and now they're trying to do something, and the market thinks they are late, or they are just reacting. Okay, what would be a good example? Probably Argentina, ladies and gentlemen. Okay, so you see the central bank jacking, and that's a very extreme measure, jacking it up to 40%. Okay. And I hope it never happens here. Okay. And then maybe, I don't know what the Argentinian bond market did yesterday, although I imagine it probably is not pretty. Okay. So that's when the long end would go up even more. Okay. Now maybe we look at one more, and then I'll just, which one do you want to have a look at? We can look at maybe number 2. Okay, so this is what I call a bull flattening. Now, what is a bull flattening? Bull flattening is when the long yields are falling and the short yields are not really changing much. Okay, this usually happens if you look at the commentary that I've written, when central banks are not really doing much, so the market will just react to general growth prospects and demand and supply and fiscal outlook and so on. The best example I can think of is if you look at the US market in 2010 and 2015. Now, those 5 years were not really that good in terms of economic growth. Okay, so the short rate didn't do much, but the longer term yields, they came down bit by bit because people realized that whatever growth prospects were priced into the market, they just didn't come around, which kind of partly answer this question here. I remember you mentioned the narrowing gap between the yields for 2-year and 10-year can be an indicator for future recession. It may not indicate recession so much, okay? It just indicates that the economy is not really that busy, okay? So if you let's say if you choose 2010, all right, compared to 2015, you hit go, you get quite different curves. Okay, so 2010 is the one on top, and then it just over a period of 5 years, it might have gone up and down, but the general direction is unmistakable. Okay, so nothing much happened at the short end because the central bank didn't do much. Okay. Just have a meeting every couple of months and have a coffee, and that's it. Okay, but the long end, little by little, they realize, okay, the growth isn't really that good. Yeah, I think I'll leave it there. Okay, I hope this is helpful for you, and I hope it's interesting. Now, I have some notes that I have put together regarding ISDA. I'm not going to go through all of it. So you should know by now what ISDA is. And, you know, so much of what Ryan does revolves around having good documentation, and ISDA is in the middle of that. So there is in the whole documentation package standard, there's a master agreement, there's a schedule to the master, there are ISDA definitions, and he actually, last night when we talked about credit default swaps, a couple of times he mentioned things like reference entity, reference obligation, credit events. All of these things actually are part of ISDA definition, and I was very tempted to shout out that, you know, credit default swap contracts are legal intensive, and a lot of it contains, you know, the typical sort of derivative language. See if I can find a copy to show you. Right? So I think I do have something. This credit derivative definitions. Okay, so this is wow, so many references to reference. Okay, reference. Can you see on the left hand side? Reference entity, reference obligation. Maybe you guys. Okay, I'll switch back to. Sorry. So this is the full package. This is the works. Okay. So what is a reference entity? Reference obligation, reference price. All of those things you will find in here. Now, I don't think you should, unless you got serious problems sleeping, okay, I don't recommend you go here and start reading it from beginning to end. This would be like, you know, trying to memorize a telephone book. I mean, what the hell for? But it is, you get an idea of the things that are involved, okay? What is a succession event? If you want to know about restructuring, hold on. They probably tell you somewhere. Sovereign, restructured, deliverable obligations. Oh, a lot of things that you are curious about, you will find some explanations in here. Okay? It's a good way to learn, but it's just a bit boring. Okay? So that's the definition. And deal confirmation, well, that's just when you are doing a deal, okay? But the CSA, or Credit Support Annex, is where I guess we like to spend a bit of time. And I say here, it's remastered, okay? You know what that word means, right? So remaster is, in the music industry, is when you, or in the movie industry, so you've already done something and you've shown everyone, and years later you take out the tapes and you remaster it to produce a better version. Okay, so this is remastered. Now this is important, and I'm sure Ryan would like you to get to know this. Okay, so a credit support annex, or CSA for short, is just a grand term for margin trading. That's the way I like to think about it. Okay? So two parties trading with each other, and we have a long dated deal, big amount of money, and if you start to lose money, at least on a mark-to-market basis, okay, so you have to post margins to me, and if I start losing money, I have to post margins to you. That's it. Okay, that's the credit support annex. But there are some essential terms that you should know. And I might have mentioned to you, I don't want you to read this, that in the old days, when you are negotiating the ISDA, you need certainly 1, 2, 3, and then when you are doing a trade, then number 4 will appear. You don't have to have number 5, okay? So number 5 is voluntary, but nowadays it's practically compulsory because people don't trust each other anymore, especially after Lehman Brothers. Okay? So CSA is very common. Do you remember the important parameters in a CSA? So what is a CSA? There are two, and the first one is called threshold. See, I'm telling you this because what I've noticed is that Ryan, so like I said, he treats all of you guys as professionals. And sometimes in the middle of his lecture, he would blurt out and starts talking about threshold. And I see faces, you guys are, huh? What's that? Okay. So I just try and, anticipate him. So threshold is, and you should know this because we touched on this in capital markets. Okay. So the amount above which you need to post collateral. And then there's the what's called the minimum transfer amount. Okay. I think this is just the basic that you should know, which is the minimum amount that will trigger a transfer. Okay. And I think it's easier now for you to understand these things because now you have more exposure with someone who is actually a specialist in the derivative world. Now, give you an example, okay? On CSA. So let's just imagine that there is a bank and they have, as party A, they've done a total return swap or TRS with a customer who's party B. Party B is the one who wants the risk. And so party B basically wants to take credit risk. Okay? So you flick back to the previous page. When you want to buy bonds, that's the traditional way, that's the old-fashioned way. Or in a CDS context, when you sell protection and someone pays you for it, it is like paying you a credit premium, or you are buying, or you are long, basically you're long credit risk, that's it, okay? So on the, I've already written that there. Okay, so you're long credit risk, and then on the other side is when you are short credit risk, okay? Always think whether you are long or short. So you have a deal like this, 10-year. Bond is 10 years, it doesn't matter. The total return swap is 5 years. There is an ISDA, and there's a CSA between them. Initial margin, sometimes called IM. We didn't really discuss this, so we kind of assumed that the initial margin was 0. When a customer is trading with a bank, more often than not, when we say initial margin, is the customer paying the bank. So if you have not noticed yet, a lot of the time when Ryan speaks, he mostly speaks from the bank's point of view. Okay, maybe you already have noticed. Okay, now let's say there's a threshold of 3 million, and there's a minimum transfer amount of 200,000. So I have a very simple case where you can see that over a period of 7 or 8 days, there is a mark-to-market swing, and this is actually, all of it is from A's point of view, so it's from the bank's point of view, not from the client's point of view. Okay?
So in a total return swap, typically you just pay the funding plus a spread, okay, and then you get the performance. So the economic result of that is a little bit like borrowing money for party B anyway. It's like borrowing money and then use that borrowed money to buy a bond. It's very, very similar. Right? But like what I said to you last time, I think I said this last time. If you want vitamin C, there are many, many ways for you to get that. You can eat an orange, drink orange juice, right? You take some tablets. Your end purpose is the same, but how you get there is different. And you may do different things for different reasons. Okay, I'll go back to the quiz of last week in a moment, and you'll see why. Okay, but anyway, so here, so the mark-to-market goes against the customer increasingly, but there's nothing to pay until you get to day 4, when the mark-to-market now is 3.22, and because it exceeds the threshold, which is 3 million. So it's another way of saying, if your losses are more than 3 million, please pay the excess. As long as the excess is more than the minimum transfer, which is 200,000. Okay. Now the day after, the mark-to-market is now 3.38. So in theory, party B should give to party A another 0.16 million additional, okay? But because this transfer amount will be less than the minimum transfer, so for operational reasons, they say to each other, let's not bother about that. Okay? But the day after is different. So that's the example. Is everyone okay? Yeah. So you should try to understand this, not just for this course, but when you get out there, as long as you are working, in the bank or with the bank, okay, this will come back at some point in time. Okay. Now, if you're okay with that, what I would like to do is I want to have a look at the I'll show you what a CSA actually, so at least you know what it looks like. Okay? So it's only around 15 pages. This is a real one between Barclays and somebody, right? So you just have the delivery amount, the transfer, and the threshold and minimum transfer. If you disputed calculations, when there's a dispute, what are you going to do? This is the sort of stuff that keeps lawyers employed. Okay, but anyway, I want to have a look at I want to have a look at the quiz of last week. Okay, now this was the quiz. Do you remember that? Before we do this, let me make one more point. So last night, so Ryan was busy making some slides, not slides. He had some handwritten notes, and there was one page which I think is quite important when he wrote. At the end when you guys were doing the quiz, and chatting to each other. He was busy doing the calculation, right? That page. But I haven't had time to look at, well, by the time I got home, it was already like 12 o'clock. But next week, I will go through that with you, okay? I think some of you were a bit lost. Generally, if you have questions, feel free to let me know as well. I think a lot of the questions that I heard you guys were asking, I can possibly, tackle them for you. But next week we'll do that. Okay. I think last night some of you were wondering, lost in the forest. But today, I want to have a look at this. Okay. So this was the quiz for last week. Now, so like I said earlier, so when you want vitamin C, you would sometimes eat an orange. Okay. It's a lot of trouble, and you get your hands dirty and this and that. Drinking orange juice is easier. Okay? The end results are similar. I don't say identical, they are similar. Okay? Here you have two products which may give you the same economic outcome, but are radically different in terms of capital treatment. And when I say to you, always think of why are people doing this instead of that? Why are you drinking orange juice? Why are you taking vitamin tablets? There is always a reason, okay? Why are people doing TRS instead of repo? The reason is to do with capital, okay? Now here, so first of all, we assume, okay, by the way, so this is from the bank's point of view. And what I mean by that is the bank is the one who is lending money, lending cash, and then taking the bonds. So this is the client, okay, who is long the credit risk. The client is taking the credit risk, okay? So they're the one who is long. So in the case of repo, they're the ones who are buying the bonds and taking the credit risk of the bonds, but also passing the bonds to the bank in order to get the funding. Okay, so and Ryan, this question is from the bank's point of view. That's important to remember, because if you look at it from the client's point of view, or if the bank was not lending money but borrowing money, you get a different picture. Okay, now so and then the second one, actually, or the first one I should say, so total return swap. This is a derivative, and repo is not. It's kind of on balance sheet, and that makes a world of difference in terms of treatment. Now, for derivative, you know that by now, especially in the swap market. So the way the regulators deal with that. So when you have a derivative transaction for $100 million, the first thing or 300 million, the first thing to remember is that by regulation, central banks will require a bank to have some capital set aside. You might wonder, well, how much? Well, and this is not always very scientific, I find, okay? They describe what's called an add-on factor, okay? And here the add-on factor is 10%. So the capital that is required, okay, would be the notional amount, 300 million, multiplied by the add-on factor, which is 30 million, and then the the leverage ratio is 5%. Okay, so now you all know what the leverage ratio, you know what that means? Yeah? I'm running out of space. How should I do this? I'll just do it here. I hope I can remember all the details. So there's a notional, which is 300 million. There's the add-on. This is kind of like the risk factor. Again, I don't find this very scientific. Why is it 10? Well, because the central bank says so. Okay. So they would treat this as if you have got a $30 million leverage on your balance sheet. Okay. And then because the leverage ratio is equal to 5%, so that means when there's $30 million of additional leverage, they want you to have at least this amount of capital backing it, which is $1.5 million. Okay. Now, what is the cost of capital on this? So the cost of funds, okay, would be simply, if you want the dollar value, is this multiplied by the cost of capital, which is 12%. Sometimes called the required return on equity. It is what it is the amount of money, or it is the cost for you to raise capital, for someone to give you capital to do whatever you want to do. Okay, this is what they expect to be repaid. Okay, so that is simply what, 180,000. Now that's all driven by the fact that the additional leverage because of this transaction is $30 million. But if you look at the repo, that's altogether quite different. Okay, so the repo, there is a 15% haircut. Okay, so from the bank's point of view, it means that when they give you the bonds, what you're going to do to this client is you are going to give them $300 million times 85%. Now you have to get that money from somewhere. In other words, you have to borrow that money from outside. Okay. Now that's going to impact your balance sheet. You meaning you are the bank. So to look at it in the simplest possible way, okay, if this was your balance sheet before, so after you do this trade, your balance sheet is going to increase. By how much? By $255 million. That's a lot of leverage. Okay? And we already said the leverage ratio is, was it 5%? 5%. Okay? So for the repo, I'll let you have these notes. Okay? The notional is now 255, and then there's no add-on, okay, but the leverage is the same. This is how much additional space you have expanded on your balance sheet. And balance sheet is very expensive. It's like real estate in Central. So if this is the leverage, okay, and the leverage ratio is the same, leverage ratio is 5%. So you think about this from the bank's point of view, okay? So on the other side, you basically you made a loan to the, but the asset side is not so important here, right? And the amount of capital that you need to satisfy the regulators would be this multiplied by 5%, and on that you need to make 12%. That's your cost. What does that come to? What? 1.53 million. So the net difference is huge. There is an advantage of $1.35 million in terms of capital cost savings. Okay, now that is the reason why a lot of banks would rush to engage clients to do the total return swap instead of the repo, and they just yeah, maybe another day. Yeah, let us think about it. Okay, I think this is a very good example of what I would call regulatory arbitrage. It's not really arbitrage, but because of regulations, okay, bankers would gravitate towards one set of products instead of another. You see this happen all the time. Basel II itself was because of that. Is everyone okay? Yeah? Did you get this right? Some of you did, I know, I looked at the answers. All right. So just think of how much leverage or how much stress, if you want to think of it that way, you are creating on your balance sheet as a result. And then think of how much capital would be required, and then think of the cost on that capital. Yeah. I know what I stands for. I must be initial. It's initial something. Is it initial margins? But margin starts with M, right? Does anyone know what IA means? Ah, right. The independent amount. Notice I have not actually used that parameter in trying to work out the capital requirement for the TRS. That could be, the independent amount could be the same as the threshold. No? So I'm not sometimes the best with alternate definitions. Here you go. Yeah. Yeah. I think that parameter, okay, look at what I've got up there. You see, I said to you, the I stands for initial. It is true, but the initial has to go with margin. It's either that or it's the independent amount, as it is called in the CSA, is a confusing term. I didn't say that, okay, they did. Can mean the amount that the parties may need to transfer. This parameter is not used in the answering this question. He just threw that in to confuse you guys. Did he succeed? Okay. All right, I'm going to let you go. We have another very exciting lecture coming up on financial modeling. If you haven't signed in yet, please remember to do so before you leave. And I thank you for coming today. Okay, have a very nice weekend.